everybody. Robert A. Bonavito, New Jersey forensic accountant. Today we're going to talk about Goodwill in corporate acquisitions. We did another video on litigation because both of these topics are kind of related, dealing with Goodwill. So let's understand what Goodwill is. Okay, basically what Goodwill is a plug, because when someone buys a company and they add up all the assets and subtract the liabilities and put everything at fair market value, you know, the building and equipment, there's usually a difference. So if you buy something for, let's say, $1 million and you add up all the assets, subtract all the liabilities at fair market value, and the difference you have to put somewhere, and you call it goodwill, right? So everything has to balance out in accounting. And this becomes really interesting when you have these companies on a stock exchange buying other companies. Now, tax treatment of goodwill in a business acquisition. First of all, you have this goodwill, like I said, you know, let's say it's a $2 billion. It was a $10 billion acquisition and the assets are only worth $8 billion. That has to be amortized over 15 years or 180 months, okay? And for the seller, he pays capital gains tax on the difference. That's pretty straightforward. So let's talk a little bit why it matters. Okay, first of all, a lot of this plug number is significant. You need to put it on the balance sheet, so having goodwill there is important. And we have IRS rules, and we have FASB rules, and all that kind of stuff. It can be critical in shareholder disputes, divorce, or financial reporting. We talked a little bit about that in the other video. Some states recognize personal goodwill or enterprise goodwill. New Jersey generally does not let that take place, especially in divorces or stockholder disputes. It affects the balance sheet, obviously, because you have to put it as an intangible asset, right? And you amortize it over 180 months. Now let's talk about what I think is probably the worst run company, and one of the worst run companies, AT&T, and we'll use that as an example. And the reason I like to use them as an example, because now they have good management, but they had the worst management for decades. They would buy companies, like they bought Time Warner for $108 billion. I don't know what a phone company thinks they're going to be able, how they're going to be able to manage, this type of a totally different type of company. They can barely manage AT&T. This is a while ago, like I said. Management last 2 years for AT&T was good. But what happened? I mean, it wasn't really a surprise, right? They had a write-down because when they bought it, a lot of the purchase was allocated to goodwill. They had to write down $39 billion because the asset just depreciated. Obviously, or the value went way down because they mismanaged the asset. So they overpaid. Then they had to write it down to reflect it properly on the balance sheet. But let's go through another one of the disasters at AT&T. I just love meeting people who worked at AT&T or ran, the higher ups. They're just totally clueless. I mean, this company was crazy. But let's talk about the DirecTV purchase. Okay, we talked a little bit of Time Warner to get a better understanding how this works. Now, they acquired by AT&T Inc. They targeted DirecTV. They valued it at $67 billion. Okay, and it was structured as cashless stock. Now, goodwill was created because even though they were valuing it at $67 billion, when they added up the assets and subtracted the liabilities, they were short $32 billion. So they're overpaying for DirecTV by $32 billion, right? It's a large portion, almost half of the purchase price. I mean, these guys, it's just amazing what people do who run these public companies. AT&T is one of the worst, but a lot of them do the same thing. They buy these businesses they shouldn't be in, they run them into the ground, they get a gold parachute, and they leave. So what happened? Okay, this is not rocket scientists. We know that they couldn't manage DirecTV. They couldn't manage DirecTV. They didn't have the know-how or the experience, and they had what's called goodwill impairment. Now, as a shareholder, they have impairment, and what they said was what happened was cord cutting. They knew that when they bought it. Competitive pressures from others, they knew that existed. I mean, these are not things that they didn't know, or most people wouldn't have known when they bought it for over $60 billion. and they lower margins, lost a lot of customers. So what did they can't have this on their balance sheet, right? They got to reflect this impairment of goodwill because this reflects their incompetency. Now, so the impairment charge, right? They took a $15 billion impairment charge. They wrote down the asset by only $15 billion. They should have wrote it down by a lot more. And just think what's going on here. They went in to buy a business. They created goodwill. That goodwill started to disappear, so they started to write it down. And this is an actual $15 billion charge on the income statement. Now, they do this, like I said, this is something that they kind of fix. They're really focused on their knitting now. But they would buy these businesses like Time Warner or DirecTV, put them on their balance sheet, then write them down in 3 or 4 years for these tremendous losses. And then what they said here in the 10K that they had to file non-cash impairment charge reflects the impact of competitors and continued secular decline in paid. What they really should have said is we overpaid. This all existed when we bought the company. We didn't have the management people to address any of these issues, and we took a write-down. But this is what they said happened. I mean, they didn't know it when they paid $60 billion for it. So this is why this goodwill is important. Very important. So listen, hopefully you guys enjoyed this video. If you do, smash the like button. If you have any questions, let me or one of my consultants know, and we will get back to you. Thank you. Bye.